Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action. All right, today we have Robert Martinez with us with Rockstar Capital. Looking forward to this conversation. Robert has amassed quite a few units down in Texas. Robert, do you just want to kind of give us a little bit of background on yourself and tell us how you got here today?
Yeah, so, real estate is not part of my family. I grew up in deep South Texas. My dad was 45 years in the franchise fast food industry. So, real estate, the only real estate my parents owned was my house, the house that I grew up in. So I went to Texas A&M, got an engineering degree because that's what I thought I should do to make the most amount of money. I did that for about 10 years, and I was in sales. What you realize in corporate America that there's only X amount you can make. There's a ceiling. And once you get close to that ceiling, your bosses want to send you back down and start over. And so that's what would happen. That happened 2 or 3 times to me where they would play with my commission plan, play with my territory, so I couldn't make a lot. So I started looking for different things to do. And I found after about 2-3 year period of that, I found a real estate club in Houston, Texas, that was teaching single family investing. And I went there and I paid $500 to go through their 2-day boot camp. And at the end of Saturday, I was like, wow, I'm going to be the single family king. I think this is amazing. I'm going to buy a few houses and I'm going to supplement my income. Never imagined that I would leave corporate America. Then I went to Sunday, and Sunday was all about multifamily. And that's where I learned forced appreciation, something that I call today the magic formula, right? Where you can increase your NOI, and then NOI divided by a cap rate gets you valuation. When I'm an engineer by trade, so that made a lot of sense to me. Like, you can apply a formula, and this is it. No, you couldn't do that in single family houses. And so I ponied up $10,000 to join this real estate club. This is January of 2007, and I immersed myself in this club. I went to all of the free events. I went to all of the special paid member events. We had bus road trips. We had a lot of videos we would watch from previous presenters or whatever subject matter there was. And I really immersed myself. I met a partner when I was there. He and I went on to buy 2,000 units in about a 3-year time frame. And in 2011, he and I had a falling out. We ended our partnership. I had bought one deal that was mine. The other deals, he was the GP. I was more of the operating arm. But on that last bid, I bought my first deal, a property called Water Chase Apartments, in March of 2010. So when I started Rockstar Capital in April of 2011, that was my first deal. We bought another deal that month. And what we did was we just buy deep value add deals. We look for ways to improve the business. So similar to like a leveraged buyout or what you would see on a lot of movies out there, that's what we did. We raised equity, and then we would go get a loan, and we would buy this asset. We would make improvements on it, and in a 2-3 year time frame at that time, we would refinance it, get it reappraised, pull cash out, put long-term debt on it, and hold it. I got very good at that. Raised a lot of equity because I had a track record of being able to follow that business plan over and over. At one time, I had 15 100% cash out refinance events.
Wow.
It was a big deal in my real estate club. So when people see that they can give you $100K and that in a 3 to 5 year period, you're producing cash flow and you're giving them their money back and they have all the tax advantages and they still own the deal, you get a lot of attention.
Yeah.
And so that's what I did. I started buying one deal a year. And then in 2014, I started to buy a little bit more than that. And it just kept growing and growing and growing. I'm proud to say that today we have $150 million of lifetime distributions from my investors.
That's awesome.
And We've done really, really well. Yeah. So we have 22 assets in Texas, primarily concentrated in Houston, 4,415 units.
Yeah, that's amazing. So kind of talking about, like that first one, it sounds like you'd done some research and done some deals with another partner, but you start out with that first one, like getting over those hurdles of the first one, if you can remember that far back.
Oh, yeah.
What were some of
Yeah,
those
because
challenges that you went through at that time?
so so as I said, I got in the business in January of '07,
Yeah.
and by December
Perfect
of
timing,
'07,
right?
I
Right as it's going
exactly,
down.
yeah, and not too dissimilar to what just happened, right? I bought my first deal with my partner, so he was technically the GP. I was the operating arm, but on the legal documents, I'm a passive partner. I'm an LP.
Yeah.
So I put my couple $100,000 on that deal, and then we bought some deals in '08, and we bought a couple more deals in '09. And of course, what happened? You had the crash occurred
Yeah.
with what's now called the Great Recession. And I was the operator. I had to learn. I trained all the staff on how to sell, how to lease apartments, how to maintain retention. Like nobody ever tells you the number one way you make money in real estate is when everybody renews and not when they move out. Because when they
Yeah.
move out, you have vacancy loss. You have to pay marketing costs. You have commissions to your leasing agent. It doesn't work.
You
Want as
gotta fix up
much.
the unit too. So you've got
You got to
construction
fix
costs
the unit,
potentially on it
rehab
too.
it, and absolutely. So my upbringing in real estate, as you said, happened at the most critical time. I got to see deals fall and then rise again later on. When they don't ever tell you that when these deals go under, they come back again like a zombie, and they're at a fraction of the cost that the competitor you helped put into the ground came back with. So they're doing the same thing. So then it becomes a customer service game. It's all about retention, making sure that number one, when they move in, they get the right make ready that you expected, that what they saw during the tour is exactly what they get, because that will influence your work order activity.
Oh
You
yeah.
don't want your work orders to be coming from the move in from last week. You want your work orders to be coming in just, I got to change out an AC filter, or I got to change this out, like just everyday stuff,
Yeah,
something
like
broke,
a toilet
got to
starts
burn
running,
it.
right? Like that's the worst
Absolutely. You don't want to make a
it's
bad first impression.
yeah.
It's like going out on a date, right? You don't want to have bad breath or you're not going to get a second date. And that's how I tell my team is that we need to always be trying to get that second date. We need that renewal that happens in 12 months. And so we would make improvements along the way. We would change out the air conditions. In Houston, Texas, it's very hot, just like it is in Arizona. And the number one maintenance headache is air conditions. And it turns out that that's the number one reason why people move out. So as part of our rehab, we changed out all the air conditions. And
Okay.
then we started updating the appliances. We update, I don't do these Taj Mahal type renovations where people are spending 10, 20,000. I take care of the basics. You get cold air, you get hot water on demand, is pest control in line. Nobody wants to come home and there's a creepy crawler, that you see there, right? We focus a lot on that and spend a lot of money on pest control. So the key is that we're buying deals where we're going to have a renter for life. They're never going to buy a house, at least not a majority of them.
Right.
And so they're not going to leave you unless you give them a reason to leave you. They'll be a renter for life. And that's our motto, is that we need that renewal. You make your money on the renewal, because when somebody renews, you don't have to spend any money to start their new contract. And if anything, they're going to pay more in rent than they did the previous 12 months.
And if I remember correctly, too, from talking with you, you guys self-perform the property management, so you're vertically integrated.
Yeah. So my company, Rockstar Capital, we manage all of our deals. We self-manage. Along the way, we've earned 19 city, state, national apartment association awards. And I'm a 5-time owner of the year. Three times at the local level, 1 time at the state level, and 1 time at the national level.
One of the big advantages of that is like you have direct communication with those, either the on-site managers or the leasing agents, and like sounds like your background in sales training has very much helped kind of like curate that training for them.
Right. So the difference is that when you self-manage, right, you control all the meetings, you control the strategy, you control the culture, and all those are very important. Every Monday here at 12:30, goes about 2 hours, I have a leadership call. I have all my executives, that my regionals, my head of revenue management, my head of training, my head of operations, and where they're talking about the portfolio. This past week, we were talking about our make ready process. How can we speed up our make ready process? How can we have more completion? At a third party, you don't know if they're going to do that. But you know that if you own it and you own the management company and that's your kid's equity on the line, you're going to make sure you work on those things. And then on Wednesday, we have our manager calls. I try to lead those. I want to go through the stats. I want to share a little bit of what we talked about on Monday with the leadership team. But more importantly, I want feedback. How are things going at your sites? What is occurring? What's good? What's bad? We focus on resident retention. We focus on resident reviews. We focus on work order activity, and it's just any general items that come up during that call. I feel that if I have those 2 meetings every single week, if I conduct and I lead those 2 meetings every single week, then I can have the right information I need to make decisions for the portfolio.
Yeah.
I think leadership starts at the top. It absolutely does. The way I carry myself, the way I'm engaged, I can't expect anybody to do that if I'm not willing to do it. So you've got to lead by example.
So, I mean, run me through this. You buy these heavy value add deals, and presumably they've got some problems with them. But I mean, if you've got a property and it kind of starts to show some resident retention problems, I know you've kind of said focus on that. Like, if you start seeing, a bunch of tenants leaving a place, like what's kind of, your modus operandi for going in and identifying what the problem is and like how to fix it?
Yeah, I'm glad you asked. The way you fix that is that you start first in the manager chair.
Yeah.
That manager that you put there is representing a multi-million-dollar asset. The least expensive asset that I have right now is worth $10 million.
Yeah.
And I'm putting somebody there that's maybe making 50, 60,000 a year. And I need to make sure that they're making the right decisions.
Sure.
And so we train them, we watch them, we encourage them, we tell them what the metrics are. And if we start to see slowdown, we're going to make a change. As much of a people person I am, I like my money more than I like people. I want to make sure that my money's here to take care of me and my family. So I've got a very itchy trigger finger. When I bring somebody in to replace somebody else, I have a 30-day policy. You have 30 days to spark it up, meaning that you have to do better than the person you were there before. And if you cannot do better in those first 30 days, you need to go. Yeah. It doesn't take longer than that. If you've made the right hire, they're in that chair, and you brought them in because you had a problematic manager before, you should see improvement. If you see things continue to go down, if you don't see a stop, you don't see a crescendo up, then you made the wrong hire. Okay. It's literally like that. That's how business, that's how the operations of apartments work. If the manager is the right person sitting in that chair, she will make you or she will break you.
And when you say manager, that's like an on-site manager, I'm assuming there?
Property manager, yep.
Yeah, okay. And I mean, when you first buy these properties too, you presumably have you're putting someone new in place, or you're keeping the same person and you're coming out like, hey, here's the plan of like what we plan to do.
Yeah, I think it's a mixed bag. Obviously, depending on where you are in your business cycle, I want to put somebody there that I know knows my way.
Yeah.
I don't want a first-time manager. That's not going to help me in my business plan. I need somebody who's successfully helped me implement a business plan at another property. Because they know exactly the Rockstar way, what is expected there. And so you're going to comp them accordingly. Once in a while, we will retain staff depending on the person, and you interview them. And also, you want somebody that knows where the dead bodies are buried.
Yeah.
And I always have my person running congruent with that. I want to make sure that, I'm either going to stick with this person that I inherited and that I decided to keep, or I'm going to move my other person there. So they'll shadow them for a little bit. And if this person here can make it, then the other person doesn't need to come, and they'll go back to wherever they're at, or they'll go somewhere else. But, in reality, 9 times out of 10, it's a new person. I'm putting my people there. I'm not going to take on somebody's stuff. And the reason for that is that I'm buying deals that have issues.
Yeah.
Right? I'm a value add operator. So there's something wrong with this deal. And chances are you're part of the problem.
That was kind of what I was getting at. It's a lot easier to replace the person that's, part of the problem. They may not be the entire problem, but they're certainly not fixing it, right? Otherwise,
Right. So I
you're
give them
not buying
30
the deal.
days, just like I give them 30 days, just like I treat my guy, my team. And
Yeah.
they need to show me that they deserve to belong here in 30 days. So during that 30 days, I'm going to find out all that they know. I'm going to find out the good of the property. I'm going to find out the bad. I always tell them, hey, if I come with you with a bucket of money, how would you spend it? Well, the number one thing here people talk about is playground. Oh, really? Okay, cool. What else? Well, we don't have a dog park. Okay, cool. What else? And then you pump them for information, and you find out if it's credible or not.
Well, they're getting a lot of that
renovations right away.
They're not just coming up with those ideas themselves. They're talking with tenants, presumably, right? Of like,
Sure.
maybe sending out some surveys of like, hey, what does this place need, or where do you guys think this is deficient, or something like that. Like, they're supposed to be communicating that stuff up the ladder, and it's like, is it worth it or not, right?
Absolutely. And if they don't have an answer, then they're the wrong person. That means you're not walking your property. That means you're not engaging with your residents. And so what value do you have for me? You're going to do the exact same thing with me.
Yeah. What are maybe talking about like capital improvements? What are some of the like your favorite things that you've done that have like worked out well, or the favorite things that your managers have done that have worked out well?
Well, I think number one is when you take over a property, you have to change the culture.
Yeah.
You have to let them know that we're different than the guy before. That's why I bought the deal. I think I can do a better job than the guy before. And so number one is you're going to start engaging with the residents. You're going to start with resident events. You're going to get them to start promoting positive reviews. They're going to see the renovations that you're doing. If you can, you send out a renovation letter that, hey, over the next, 3 to 6 months, we're going to be making the following improvements so that they see what's coming. And then they give you feedback. What's happened a lot too is that some residents like, oh, you only fixed the new stuff. No, it's not true. I put a brand new air conditioner in your unit too.
Yeah.
And so you have to remind them of the things, right? Because they always see when a new order comes in, does renovation, it means rent's going up. So you have to alleviate that fear. And the reason why they're afraid of the rent going up is not because they can't necessarily afford it, it's because they don't think the value's there. If the value's there, they will pay for it. If you put washer and dryers in their units that they didn't have before, they'll pay an extra $15-20. Why wouldn't you? So that's what it comes down to. You got to change the attitude. You have to change the attitude of the residents there. Then you need to make life a little bit better.
Yeah.
You want to put a dog park. You want to add amenities. So we're going to fix the gym. Some of the things that we've done recently is we started adding parcel lockers. So, kind of like that Amazon style parcel locker. So if I get a package, the package gets delivered in the parcel locker. The parcel locker will send the resident a text message to say, hey, you have a package, a notification, and then here's your code to get your package. Then you go to the parcel locker setup, punch in the code, and then a locker will open up, and there's your package. People like that because it's safety. Nobody wants to buy something and have it ripped off from your front door. And in the office, I'm not the post office. I don't want my teams handing your packages. That's not what they're paid to do. We're not one of those little, post-its that you see there in the retail centers or strip malls. We're a property management company. That's not what we want to do. So parcel lockers are great. It's a great amenity. And because of that, we get to charge $15 on top of our rent as an amenity fee for that. And a $25,000 investment can be a $400,000 or $500,000 lift or a $400,000 or $500,000 gain to your valuation. We started adding cameras. Years ago when I got involved in real estate in 07, 08, I was told, don't put cameras on your property because the residents see that and it opens you up to liability. That was just small-minded thinking. In 2026, crime has no zip code. If I see a property that has cameras and there's like blinking red and blue lights there and they're all over, I'm like, wow, they care about their residents.
Yeah.
That's how I would feel if I was moving in. And there's always this perception that, oh no, it's like, it's going to show liability that you had. And no, that's not how it works. First of all, we have property insurance, and property insurance will cover any kind of issues that we have that are to our negligence. But having those cameras there is a winner. That adds a sense of security. No place is safe, but it adds a sense of security there and comfort when the residents walking around and they're looking at the grounds and they see a camera there with red and blue lights, they feel safe. And then they see another camera on the corner, and then they see another camera on another side of the property. They feel good. So these are just a couple of things that we've added to increase the NOI. The last 36 months have been crazy. We had tax increases. We had property insurance almost triple. You had interest rate exposure where rates went up, skyrocketed. It was a lot of negative, right? You had to manufacture NOI to help you overcome that and get out of that floating rate debt. So we either came up with something where we helped add the income or we found a way to help reduce expenses.
Yeah. Well, and not only that, the other kicker too is a lot of rents were kind of flat over the last couple of years in a lot of different markets. So really coming up with extra value to bump that NOI sounds pretty imperative, especially when you're trying to refinance or get some additional loans.
Yep.
So kind of backing up, you said you did kind of like one deal a year, and then you were doing a refinance and getting a lot of investors' money back. So I guess kind of like talk me through like how you like cultivated those investors, and then what it was like when you're giving them their money back and then asking them presumably for more money on the next deal. Like, yeah, just kind of go through that a little bit with me.
Yeah, remember, you have to remember who we are. We are stock market alternatives.
Yeah.
That's what corporate America has ingrained in us, right? From the minute you come out of college or whatever, put money away in your 401k. Where does that 401k go? It goes to the stock market. It grows those companies, but you have no voice. You have no influence. You don't know who's managing your money. And the difference in what I do is that when I raise the equity, I am personally asking you for equity to invest with me. I'm going to put $300 to $500 to $800,000. I think is my largest equity investment. They see that as a strength. I'm asking you to come invest with me. And then we're going to have monthly calls. You're not going to get monthly calls investing in the stock market. We do monthly calls. We've been doing that ever since 2022 when everything started to go south. I needed my investors to know from me what's occurring, not reading the news, not letting somebody else control the narrative, letting them know, here's what's going on with your investment. And here's our plan to correct it. And then once we corrected it, okay, here's our plan to get to an exit in 2 years from now. We're going to implement the parcel lockers. We're going to put these cameras. We're going to do this renovation update. We're going to do these different things. When you can stay in contact with your investors month after month, nobody's going to break that because I'm going to be compared to you. I'm going to be compared to somebody else. And they're going to like, wow, who gives me the most information about my deal? Is it brand X or is it Robert at Rockstar? And that's how I look. I figure that the more face time I have with you, the less time anybody has to talk to you. And that's an old sales rule, right? Like if you're not talking to me, you're talking to somebody else. Well, I'm going to guarantee that you're going to talk to me at least once a month, and we're going to have an 1.5 to 2 hour call, and we're going to go through our portfolio, and you're going to get a chance to do Q&A. I've been told time and time again that almost nobody else does that. Nobody else is as transparent and communicative as I am. So it's working for us, and that's how you cultivate a relationship.
Yeah, I being vertically integrated too, I think allows for additional transparency, just because of the fact that like you're doing those level 10 meetings or the your leadership meetings and being involved with the actual management company that much. I think that definitely gives a lot more credit to the information that you're providing too. We're vertically integrated. We're vertically integrated, and like we send so much information with our quarterly reports. It's kind of ridiculous, but we have the ability to do that because we're the ones running the management company. And
absolutely, you're in the front lines.
Yeah,
your boots on the ground. When you're a solo operator that's vertically integrated, you can control things. You can forecast, and then you have an update a month or 2 months later. Did you hit your forecast? Yep, we hit our occupancy number. They see that. They know that you're the guy in control. And then of course, when you are dealing with stuff every day, you sound more confident on camera. You sound more confident in conversations because you're living this every single day. So no, and nobody can bullshit you. You know what stuff costs. For example, I had a situation very recently where I had a he said, she said, where allegedly I had a maintenance guy touching somebody inappropriately. And again, I've been doing this since 2007. I know how this works. It was consensual until somebody said they didn't want to play anymore.
You're right.
And once we did our investigation, what do you think happened? You find out that the accuser is married and has children, so she has something to lose.
Yeah.
You find out that the other guy starts to develop hardcore feelings, and he's trying to, he's not being uninvited. He's being invited. We find the chat messages, the text messages. You see the different things of what they're talking about. And like, that's inappropriate. See, it's always the same thing over and over again. That's why I kind of like this, because, it's not rocket science. It's a formula over and over again. If I see a property go down, I'm going to go to the manager, and something has happened in that manager's life. They've lost focus for some reason.
Yeah, there's often something extracurricular with work product if they've been good in the past.
It's black and white numbers, right? Numbers are great because you have a reference point. And like, well, we used to be here and now we're here. What's going on?
Yeah.
And you need, when you've done this enough, there's only so many answers. There's only so many explanations. I've heard stuff like, oh, we have new competition down the road, or this and this and that. But, it's never that. No. It's always the most easiest, simplest answer is what it is.
Yeah, often it very much is. We definitely have had some employees that were something extracurricular is going on in their life, and it's like maybe it's worth a little bit of grace, but definitely need to refocus and get them back on track. So, you said you started off with a couple deals, and from then till now, like that's a significant amount of employees that you now have, and a significant amount of money you're managing. Like I kind of got to believe that there's usually some glass ceilings in there of like, that first level, you've got just the managers you're dealing with property management, but then you got to move up and then start hiring these regional managers. Like, what were some of the challenges you felt like you went through to add in that extra layer of management?
If you promote from within, it goes a lot easier. It's when you hire from outside that you have problems, because they don't know the Rockstar way.
Yeah.
They know what Greystar told them. They know what Camden told them. They know, but those are all third-party management companies. It's very different working at a owner-managed property management company.
Yeah.
Where the owner cannot be bullshit on stuff, where the owner's got a significant amount of his life savings and his kid's future in these deals, right? He's going to work it. And so what happens is I need to grow. I need to develop a bench. And the better my bench has been, the better our expansion plans happen. If my bench gets light or weak or thin, then I don't have the same results later on. And I'm forced to bring in outside people. And again, those outside people, it's hit and miss.
Yeah.
It's hit and miss. Most ideal candidate for me is somebody that I hire as a leasing agent who shows that they can lease. Because that's the number one skill of any property manager later on, is your ability to lease yourself out of a situation. So if you have sales experience, that's number one. Then I go, can you collect rents? Can you be the assistant manager? Can you go knock on doors when somebody's late and not feel bad about it? Then can you be promoted to property manager and run a team? Can you work? Because now that you know how you're a successful leasing agent that got promoted, you're a successful assistant manager that got promoted. So surely you know what those positions should look like. Then you got to work with your maintenance teams. You got to work with your elite maintenance and have that conversation every single morning. What is our focus today? What is our task? Did we hit yesterday's assignments? And then the best of the best, they then become, for me in my group, multi-site managers. If you're doing great at my property water chase, man, I'm struggling at this other deal. Why don't I make you the multi-site manager to where you can oversee that? And that happened to us recently where we were having some issues. And now both of those properties are 99%, believe it or not, ranked 1 and 2 in my portfolio because we hired the right manager who knew what she was doing, or promoted the right manager, who knew what she was doing. And she just duplicated the process. Yeah. Then you get into a regional. And your regional, can they do not just 2 deals? Can they do 5 deals? Can they do 7 deals? And that's where you start to test them, right? Where are they able to manage their time? Are they able to inspire their team and do what they did at the manager level or at the multi-site level, but now overseeing others, right? You're learning best practices. You're learning the Rockstar way. Are you able to put the Rockstar way and guarantee that that's occurring every single day on those larger deals? So I think as long as we've had staff that we could promote and a bench to work with, we've had success. It's when that didn't happen that we struggled.
Is there we do a lot more single family and smaller multifamily, and we kind of have like maybe door counts for leasing agents and that sort of stuff. Do you guys have any metrics of like just knowing that like, okay, a leasing agent can handle 200 doors, or a regional can handle 1,200 doors or something like that, to kind of get an idea on whether you have capability of adding another property for a certain employee or a certain group of employees or anything?
Yeah, you have your staff complement, and
Yeah.
on a 100-unit deal, I'm going to put one person in the office, which is going to be your property manager, and they're going to have to be the leasing agent, and they're going to have to be the assistant manager.
Yeah.
There's no more room in the budget for that.
No.
It's only 100 units.
Yeah.
And then I'm going to put the rest of my budget in my maintenance team, and I'm going to have hopefully at least 2 people on the outside. So I use that as my basics. I need a lead maintenance, and I need like a ticket, or I'm sorry, like a make ready guy.
Yeah.
That can get units ready to do that. So my lead maintenance is going to manage all the work orders and tickets, and he's going to assist the make ready guy when he has to.
When he has time.
And that's been a good combination for us. So if I'm going to buy a 200-unit deal, then I'm just going to double that up. I'm going to add another person in the office, and I'm going to have a larger team on the outside. And so we kind of stick within that ratio.
Okay. And then your regionals, they're like doing 3 to 10 properties or something, and like up to 1,000 units or 1,200 or.
Yeah. The multi-sites are typically doing 2 or 3 properties at most.
Yeah.
And then your regionals, which are not the day-to-day managers. At a multi-site, you're the day-to-day manager. You're just managing this property remotely from this property. And you're telling them over here on the property that's 10 minutes away what they need to do. And then you're going to go over there tomorrow, and you're going to work out of that property. Then you're going to tell the property over here you worked out yesterday how to run those things. Then you have your regionals. And these are the guys that are looking at the financials. They're looking at your work order completion. They're looking at your make ready completion. They're making sure that the property is being run the way they would run it. And if it's not, you make training, you make corrections, and then you make recommendations for termination if they can't do it.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
Yeah. And I guess, how much turnover are you kind of having on that lower? It sounds like your upper end people, you've promoted from within, so they're sticking around probably fairly often, but that leasing agent, and you say you're kind of giving them 30 days on a performance plan, and if they're not getting it up to snuff or doing the right stuff, they're gone and hiring someone else.
Yeah, so very rarely do I lose somebody that I wanted to keep.
Yeah.
When I lose somebody, it's because I asked them to leave.
Yeah.
And if I'm asking to leave, I have a good reason. They're damaging the business. So I don't really look at the turnover rate per se. I'm like, are you the right fit for this business? Right? Because I'm running 22 different businesses.
Yeah.
And they consist of, 4,400 units. Can you run the 200 units, right? That's about a 200 unit average. Can you run the 200 units that you're there? Can you lease apartments? Can you manage the property? Can you get units ready? That's all we do. And can you do it in a quality kind of way? So I'm constantly turning staff because I'm looking for diamonds in the rough. I'm literally there like I'm panning for gold. I'm looking for that nugget because within every 10 people, there's that one nugget there that can be a superstar and be promotable. And so, again, I've never lost anybody, or in my current situation, I don't lose people that I did not want to lose.
Yeah.
It's always because I terminated them.
No, that's great. Yeah.
I mean, think about it, right? From my position, I've signed on over $300 million of loans right now in my portfolio. So everything is running on me. And then I've raised your money. I've raised $180 million. Actually, no, I'm sorry, $200 million. We just updated our totals. $200 million of my investors' cash. I don't have a lot of wiggle room.
No.
I don't have a lot of sympathy for things that are not working. I'm running a business. You're paid to, you're compensated to run this business because you said you could do it. And if you can't, then I got to be the adult in the room and say, hey, I'm sorry, it's just not working out. Because that's what you as the investor expect me to do. Now that sounds kind of a little hardcore. And I wasn't like that in my earlier days. 52 now, I've been doing this 19 years. I definitely hardened up over the years. And certainly, after COVID, 2022, 2023, 2024, I got super hard.
Yeah.
I've gone through, I've seen what hell looks like when you wake up one morning and the sky is no longer blue and water is no longer wet. You've lost half of your valuations because your insurance jumped from $700 a door to $1,700 a door. Or you saw a 70% increase in your property tax, or you saw your interest rate, you saw the cap rates going the wrong direction, and now I've lost valuation, and now I'm not even worth loan value. I've lived that. I've seen where that happens. I hate Jeremy Powell. That guy had no idea what he was doing with raising debt 5.25 points in a 15-month period. He absolutely crushed the real estate world and put a lot of people that I know out of business. And I'm glad that we have some stability now, but we had to be prepared for that. Like, nobody's going to cry for me.
No.
So if I'm going to make sure that I make the right business decisions and put the right people in the right places.
So, after going through kind of that period of hard times now, has that changed your way that you buy deals?
I'll tell you what. So I've gotten very defensive of my underwriting. I've learned now, the things that occurred, I want everybody listening to understand the things that occurred the last 3 years had never happened before. And if they had never happened in the trifecta that they did. We never saw insurance go from $700 a door to $1,700 a door. That's almost 3x, 2.5x. You've never seen at the same time taxes jump, 40 to 50 to 60%. And then you didn't see interest rates spike, which meant that cap rates went the wrong direction and your property is now undervalued. Nobody has ever had to see that before. So the number one way is liquidity. You gotta have cash to make sure that you can withstand a storm. And I thought I had enough cash during COVID and slowdowns we've had here in Houston. This one really tested us.
Yeah,
absolutely. You had significant issues that occurred between 22 and 2024. We had interest rate exposure. I'm proud to say that during that time, I was able to refinance 12 deals that I had floating rate debt. I got them refinanced. I saved the equity on those deals.
Yeah.
I manufactured the NOI to get the valuation necessary for those refinances to occur. And so with that, I'm like, okay, what hurt me here? Well, a lack of cash on some deals. I think anybody underwriting should have nothing less than 6 months and ideally 12 months of expenses, not including property tax, not including insurance, not including your mortgage, 12 months of your everyday expenses. You got to have that for a rainy day. 2, you can't be over leveraged. The guys that bid it first were the guys that were over leveraged.
Yeah.
And I feel bad for those guys We all bought in the cycle. If somebody didn't get hurt during that 3-year cycle, they really weren't a player. They really weren't active in the market, because anybody who was active in the market had exposure. Everybody saw it. Nobody saw what Jeremy Powell, the devil, was going to do. And so even if you didn't get the rent growth, nobody expected valuation to fall off the way it did. So you've got to come in lower leverage, 65%, ideally, no more than 75%. So if you have the lowest debt service you can have, and you have a cushion of minimum 6 months to 12 months of operating expenses, then you can probably do well. You don't have bad deals, you have bad loans, is what happened. And so
yeah, for sure.
Like these deals the deals that went south, they were fine, and they were identified the right way. I don't think anybody went and bought a bad deal. I think they just had bad loans.
I mean, my experience with the underwriting, if you're underwriting and putting in, we've added some extra vacancy in the first year, some bad debt going in. Typically IRRs on expectations just come down. And so the attractiveness and the marketability of the deal goes down, but it's significantly safer, less risk. We didn't do any of the adjustables. We did mostly 5-year debt. And we get beaten out on projects of guys that were offering, 20% IRR. So, there's a fine line of like, how conservative do you be on the underwriting versus like, do you want to be a player, like you say, right?
It is, yeah. Everybody's different, right? It depends what your buying philosophy is. I can tell you, everybody's buying philosophy got turned upside down May of 2022.
Yeah,
it completely turned upside down. And today I put an offer in on a deal yesterday for $80,000 a door. The deal traded for $110,000 a door in 2022. It happens, and no one has ever seen that happen. It didn't happen like that during the Great Recession. That was a completely different ballgame. This was something that was very dramatic, and it created a lot of damage. Now, I will say the silver lining to it all is that what goes down fast has to come up fast too.
Yeah,
it's the rubber band approach. So if you can withstand and outlast that storm, there's going to be significant opportunities.
Yeah, and we've had a couple deals that it's like extend. So we're going to end up holding them a little bit longer than we anticipated. But, if you can, like you said, withstand that, and, it's got to come back up and probably even go up further too.
Anything today, if you own it in January of 2022, whatever you own today is worth 20% less.
Yeah.
And that's because of all those things that I talked about, but primarily the cap rates. The cap rates changed and they went in the wrong direction. Expenses have gone up, payroll's gone up. Insurance is starting to rebound now, and it's starting to come down, and we're very excited about that. Hopefully we're looking at our third year of double-digit decreases on our insurance. But you just have to outlast that storm. I don't care who you are. If you own it in January 2022 and you still own it today, you have a 20% loss of valuation, if nothing else changed. And that's where we got really good at manufacturing NOI. You had to grow NOI to overcome and to recapture that lost equity.
Yeah. I'm going to switch kind of subjects here a little bit, but do you guys do mostly single asset syndications, or are you putting together a fund?
Yeah, I've been in the Grant Cardone world, and in fact, his real estate club, he designed it around me. I was member number one. And he teaches the fund model. I'm not a big fund guy. No. That's not how I learned. No, in the real estate club that I was brought up in, you buy one deal at a time.
Yeah.
You don't buy multiple deals. You don't cross collateralize. You don't, that's not what you do. I buy one deal at a time. So I'm going to go buy this $10 million deal. I'm going to raise, $3.5 million. I'm going to put in, let's say, anywhere from, on a size like that, I'm going to be on 10%. So anywhere about $300,000, $350,000. You like to partner with me, we'll work on that together. But, I don't think people want to invest in multiple deals that they can't see. And that's what it is. These are blind funds sometimes. You don't know what they're going to invest in. When I do a PPM in the LLC, you know exactly what we're going to invest in.
Yeah, and that the fund model, the advantages of it are you can act quickly. You don't need to necessarily get approval as long as the money's there. But conversely, as from a GP, like you're responsible for getting those returns. And if that money's not put to work, it's almost like you're emotionally invested to move quickly, which kind of like leads to potentially, jumping on a bad deal or something like that.
You make a bad decision. That's
Yeah.
right. But when you identify a deal, as the operator, right, the GP, when you identify a deal and then you put it into contract and you probably put hard money on the deal, now you have to go out and raise the equity. If you have to go slow about that and put that kind of risk, you're probably going to choose a good deal.
Yeah.
And then you're going to have high conviction on the deal. So it's going to be easy to raise the equity, right? Because if the right deal will raise any dollar of equity you want, if it's the right deal. And if it's the right deal, then you can get the right kind of financing too. And it all starts with the deal. If the deal looks good, the equity will follow it. Money follows money.
Yeah. Is there any other reasons you don't like the fund model?
I think you hit it on the head. I think it's blind. I think you don't know what the GP that you gave the money is going to invest in. And then I think it creates a series of motivators that may put your money at risk in the wrong deal so he can get paid.
Yeah.
I don't need to do that. When I find a deal, I identify it, I put in a contract, I put all the hard money. That's my money first. So if I lose it, then I lose my hard money. It's typically 1% of the deal.
Yeah.
And then I got to go out and raise the equity one at a time. I think it shows that I'm committed to that deal, that I'm not trying to grow at any cost.
Are there any provisions you put in the sales contract that, we typically put in like a couple extensions and then some more money goes hard or something like that. But I'm curious if there's any other, kind of options you put in there to.
Yeah, look, in my early days, that's a great question. In my early days, I was so conservative, right? I don't want to put hard money down.
Yeah.
I want to have the maximum. I want 30 days due diligence. I want another 30 days of the close financing contingency. And then I want to do another 30 days of extensions, right? Well, it depends on where you are in that market cycle. Back in 2007, 8, 9, 10, you could do that because deals weren't trading.
Yeah.
People didn't want to buy a deal. They were afraid because of what happened in the stock market. So you could get away with very conservative terms. But as the market tightens, you've also got to be better. Like, I don't need a GP. Like a lot of my LOIs that I get for people that want to buy my deals, it's contingent of somebody having a GP. I'm not going to give the deal to you then. Because I don't know if the GP is going to back out. And if you get backed out, then now you're leaving me holding the bag, right?
Are you talking about selling one of your deals?
Yeah, I actually have 2 deals right now.
Yeah.
That we're looking at selling. And so what I'm trying to say is that the difference between a strong buyer and a weak buyer.
Yeah.
In the early days, I was very conservative on my terms. But as you get more experience, do I really need 30 days due diligence? No. Can I shave it to 25 to separate myself? Yeah. I know where I'm going to go. The guy that's giving me all my financing is the same guy that I'm going to use for this deal. So do I really need a financing contingency? Do I really need to worry about not being able to raise the equity? Again, I've raised a lot of equity because I return money to people. I know it's there. Now, in this market, it's a little scarier, right? Because people have had cash calls, me included, and I wish they were only in my deal, but they're probably in your deal. They're in his deal. They're in other people's deals. And I don't know. You may have had you may have had a cash call also, or you may have lost a deal. So equity's a little scared right now. I think it comes down to the story. If there's a good story, then you're going to be okay. So I haven't bought a deal. Well, that's not true. I bought a deal last year because a deal that I was trying to sell because the guy fell out of contract. So I had to come in here and recap it and buy the deal again. So I can meet my maturity debt. I'm happy I did. It's a deal that I wouldn't have done that if it wasn't the most stable deal that I have in my portfolio. It's produced a 9x return for the investors. So why wouldn't I want to continue to recap it, right? The devil you know is better than the devil you don't.
The devil you don't.
I know exactly where the bodies are buried on this deal. I know what makes it work. I know what it needs. So we'll raise a little bit of renovation money, and I'll change out the appliances, and I'll do this, and I'll do whatever, minor lift that I need to do, and we'll hold it. We'll sell it in another 3 years when the market gets a little bit better. But that's how I think the terms are dependent on the guy buying the deal, and I need to separate myself from you or from anybody else. So I've got to show strength. I don't need 60 days to close a deal. In fact, the fastest I closed a deal was in 2010. My very first, I closed it in 27 days.
That's awesome.
We were done. We were done, but I stole it. I paid 1.9 million on a 118 unit. No, it's not true. Excuse me. I paid 2.9 million on a 118 unit deal.
Yeah.
And if you're doing the math, that's 24,500 a unit. And we sold it for 113,000 not too long ago. So it's like, if you get really good at this, then you can show strength and you can show separation. So again, I'm going through all the offers. We had a call for offers this week, and today's the best and final on these two deals. And I'm looking at it, and I said, I need you to distinguish the guys that need KPs and put them over here. Focus me on the guys that if you transacted with, that can raise their equity, that don't need a co-signer.
Yeah.
Now let me see what these deals look like. That's my plan for tonight. Let me see what these deals look like, what their offer price is. Let me compare it to the guys that need a KP. Okay, now the guys that have a KP, who do you feel good about? Has the KP done deals before? Is he active in the market? Has the guy that needs a KP, has he done a deal before? Or is this his first one? Because typically, guess what? The guys that need the KPs are typically the guys that have the higher offers.
For sure.
They're willing to offer more. So you
they're willing to take more risk on it, right?
Yeah. Absolutely.
Yeah. No,
now, there was another time I remember with Cardone, there was this deal I really wanted, and he's like, how gangster do you want to be? And I was like, yeah, I think I could do it. What are you suggesting? He goes, well, look, you're not going to get this deal because the other guy that you're competing with, I know who they are. They buy from this guy all the time. So you want to separate yourself? I go, yeah. He goes, you need to go hard money. Sorry, you need to wire all the earnest money before you take your final buyer call. I'm like, really? He's like, absolutely. So here I am wiring $1 million plus to a title company of my choice, and that shows strength. Yeah. When I'm on that call, I'm like, I'm the right buyer. Let me tell you how much I believe in this deal. Here's my wire receipt at FYZ title company. Go check it out. The money's there, ready to go.
Yeah,
they're certainly to close for me. Oh, and by the way, and this is a different market, but it was hard right away. Yeah, I need to show them that I was willing to do the deal.
I mean, the market right now is not indicative like that, is it? No. I mean, now it's
no. In fact, if anything, I got people who don't want to put hard money down.
Yeah,
they don't want to put hard money. They're afraid. And I'm like, okay, well, then you're probably not going to get considered.
Yeah,
I don't want a tire kicker. I got to get this deal sold in the next 120 days, and so I don't have time to monkey with you.
Have you done any 1031s, doing like the swap and drop or the drop and swap?
No, I've not done any 1031s.
No 1031s. Okay. I was just curious. We just did our first one, and I did it on a very, very small one, and it was challenging. So I was looking to get if you had any info on that.
No, I wish I could get the insight. I don't, it's complicated for me. I want to keep it simple, as simple as I can. We do a deal together. 5-10 years from now, we're going to exit out of this deal. You go your way, I go my way. We pay whatever taxes we have. Hopefully you have depreciation along the way, stockpiled or coming in, that you can offset your taxes. But I don't want to be married to any of these any of my partners forever, right? Because partnerships, they have a beginning and they have an end. Yeah, people need to realize that.
Well, and sometimes people want to be able to use their money too, right? That they made.
Sure. At some point, they don't want to be locked up.
Yeah. My brother and I, we're fair amount younger or whatnot, so we've got some maybe more time on the horizon. So we're screwing around with some of those 1031s. It can be. There's always the saying, "Swap till you drop." But
I mean, if you control it and it's your equity, sure. But if you have 25 other partners, it's hard to control that.
Yeah, for sure. Well, Robert, I think we're probably getting on time. I should probably hop to these last 4 questions. First one is going to be, what's one piece of advice you would give to your 25-year-old self?
25-year-old self. Okay. Work hard. It's going to separate you from the guy next door. Get really good at Excel so you can plug in your numbers and you can analyze stuff, and just believe it's going to work itself out. Don't worry.
Yeah. Just kind of like that, small steps every day. You can climb pretty high.
Yep. You put the time in, you put the work in. Look, you won today based on the things that you did the last 3 years.
Yeah.
The little things that you did that nobody else was willing to do, staying late, putting that extra time in, walking your sites, whatever, all of that added up so that you're winning tomorrow. It didn't happen tomorrow. It happened 3 years ago.
Yeah. Next question. What was your first entrepreneurial endeavor?
My apartment complex that I bought.
Oh, it was.
Yeah, it was. That was my first. I never bought anything else. I was a corporate America W-2 guy. I never known or thought that I could own a business. I did look at other businesses like childcare facilities. I looked at a water vending machine. I looked at laundromats. But again, I stumbled on this crazy guy on business radio, and I ended up joining that real estate club, and it was the best decision of my life. Certainly the best $10,000 I ever spent.
Awesome. That's cool. Next question is, how has your formal and informal training shaped your journey?
Really interesting. You know, when you go to college, you're surrounded by career students, and their job is to prepare you for the work world, to work for somebody else.
When you're saying when they haven't worked for someone else, they're career students.
that too, right? Yeah, that too. But they're preparing you to be a great employee.
Yeah.
And that's okay. But you're never going to get to a life that you could have. There's an expression somebody once taught me was, what gets in the way of a great life? A good life. I think everybody that goes to college or even in high school should be taught entrepreneurship. They should be taught what it's like to go out on your own, run a fictitious business, and see what it's like. Because I think until you're willing to get out of the wall that they put you in, then you're never going to see anything different. You know, my friends, I remember when I joined real estate, I have a completely different friend group today. Those guys were the friends that when I was joining that real estate club in 2007. These were guys that I met at church. These were guys that lived in my neighborhood at the end of the cul-de-sac. You know, today, all my friends that I have real regular contact and relationship with, they're all multimillionaires. They all do real estate with me. And the reason why that happens is that the conversations change. They're different. I remember somebody coming up to me and asking me, hey, so you just started this new real estate career. How's it going? And I started sharing all the things that are going on, and I'm excited about it. They almost immediately tuned it out because they didn't want to be reminded of what they're not willing to do. And it took me a long time to understand why I was losing friends. And it's because I was separating myself. And you had to get around a new group of friends. So the best part of that real estate club was there was a lot of people just like me that owned real estate. They were wanting to buy more real estate. They were all sharing ideas. It was a giant Rich Dad, Poor Dad book that came to life. And I was living every page on it every day or every time that I was in that club, or where I would show up on a bus road trip where I'd be interviewed on the radio for something. I was living it with them every single day. I was hearing the stories. I was learning from them. And then when it was my time, I was passing back the knowledge just like I'm doing now, trying to pass back the map on how I got to be financially free.
Yeah, that's insightful. I know that, it's very hard to relate sometimes with like non-business owners, like just the
100%. And the worst critics could be your mom and your dad.
Oh yeah,
because they didn't do it.
Tell me about it.
I remember when I went to Texas A&M and I got an engineering degree and I entered into the sales force. My dad's like, "Wait, you went to college to be a sales guy?" I'm like, "Dad, I'm selling engineered products. I'm making XYZ amount. I'm doing pretty well at this. I think I'm making more than you are." Right. and that was an interesting conversation. They were the critics. And then, oh my God, you joined this real estate club, right? I walked away from my day job.
Yeah.
And I started buying apartments, and I started like, oh my God, you got such a great life. You're making so much money over here selling engineered products. Why are you doing real estate? That's risky. No, it's not risky. If you know what you're doing, it's not risky.
That is very true.
It's a controlled risk. It's a calculated risk.
Well, and the point that we're at now is like, I see our deals, and I'm sure you see your deals, as like not risky at all. Just because we can predict what's going to happen. We have control over the management companies. We have control over pretty much everything. Like we're not making bets out here on the freaking blackjack table. Like we know what's going to go on and how to do it.
That's the stock market to me. You have no idea what's going on in that company. You don't have any idea. I mean, if you watch shows like Billions and these other shows, man, you are outclassed. You have no idea what these guys are doing to pump and dump a stock. And you could put your life saving in it, or you could put you hear a tip from somebody. If you're not in that game, then that's more risky. But I'm in this game. I do this every single day. I control the management company. I see where rents are going. I see what expenses are doing. I can fix that. I can literally shut something off and stop paying it.
Yep.
And you can't do that with a stock. You're relying on somebody else.
Very true. All right, last question. What was your biggest mistake and what did you learn?
The biggest mistake that I think I made was, God, I probably have a couple mistakes. It's hard to pick the ones that
which was the biggest?
I will say this. The biggest lessons you learn are from the losses.
Oh, yeah.
Not from the wins. Like, it's great to have those 100% cash out refinance events, but it's the losses that really bother you. It's the ones where you didn't hit pro forma, or you maybe even have lost equity, or really where I was going to go is that, you let the wrong staff go. You trusted one person and you let that someone had been with you for a long time. There was a period in time where I kind of started to read my own press clippings. My ego got in the way. I spent a lot of time with Grant Cardone, and he gave me the stupid shit advice to get rid of my management company and focus on buying deals. And that was the worst decision I've ever made, was walk away from my management company, hire a third-party management company to run my $700 million portfolio at the time, and they ran it into the ground.
Yeah.
I had to take it back from them 10 months later when the world turned upside down on me and resuscitate every one of those deals because they had absolutely destroyed them. So you mentioned control in the previous question. That's everything. You need to be able to have your hands on it. And the moment you take your hands off the wheel, especially to give it to somebody else, expect to crash. And that's what happened to me. I will probably never forgive myself for giving the keys to my castle to another third party management company who didn't share the same philosophy, who said one thing and did something different. It was not the Rockstar way. And the best thing I ever did was take it back and rescue those deals, do the 12 deals that I refinanced the last 36 months, and just breathe life back into my management company. And what it did was it brought me back to life. When you're doing this long enough, you recognize a lot of your identity, a lot of how you feel about yourself is on the health and success of your business. And when the health and success of your business is not good, you're not good. You're not good. And so being able to control my future, and it's not going to happen overnight, right? You got to fix things. You need time to elapse. But man, it feels good when you take in that control and then you fix something and you get across the finish line. Yeah. And so
there's definitely a sense of just like, I want to say proudness. I don't know if that's actually a word, but like, being there, being involved, and you're proud to see the success and everything along with it. I know that I moved back into one of my properties that we did a huge renovation on, and like, I'm much happier here and just proud of like seeing all the work that we've done, which is cool. Absolutely. Well, Robert, it's been a blast chatting with you. You're a wealth of information, and appreciate you taking the time to share that with us and our listeners. If anybody wants to learn more about Rockstar Capital or get in touch with you, what's a good way to get in contact?
Yeah, the number one way is to find me on Instagram. I put on a bunch of videos. I talk a lot about stuff every single day. This content is going to be recorded, and and repurposed and posted on there. So that's where you learn. You learn the lesson. So follow me at Apartment Rockstar, or find me on LinkedIn and listen to some of the articles that we post there on things that we're going through, or just want to be my friend, look me up, Robert Martinez, on Facebook.
Awesome. Well, again, thank you very much. Appreciate having you on.
Hey, thanks so much. It was great to meet you.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on Win, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.